Well, it was a good past week for both US duration and beta. Look at the long end of the curve here out from the 2-year to the 30-year. 10 to 12 basis points right across the curve. The 30-year got to 5.08. I thought that 511 was going to be taken out, and then it came down from there. So it wasn't just from 5.04 down to 492. It got to 5.08 before dropping 16 basis points. So that was a nice performance. Let's see if we can get some follow through on that with the week coming up. Money market rates not doing anything here, as they probably shouldn't. You have the FOMC meeting in 17 days. At the end of this week, the Fed goes into the quiet period, so you don't have much Fed speak left. Monday and Tuesday, you have Logan and Goolsbee both days. Wednesday, Bostic, Thursday, Harker, and then I think that's it. From Friday onwards, we're not going to hear anything from the Fed. We also get the summary of economic projections at this point in time, a new dot plot. Let's see what it puts out for the rest of the year. The probability of a move has more than doubled here, although it's still low, 2.2%, now 5.4%. Personally, I think they have permission from the data. PCE came in year over year, headline at 2.1%. Their target is 2%. Initial jobless claims jumped to 240,000. I'm going to show you some data for unemployment for new graduates. What the unemployment rate is since the beginning of the year, the jump since the beginning of the year. it's I think something to worry about. And we're going to look at the evolution of AI and we're going to look at some job reports that were the state of jobs, one by World Economic Forum, another one by, I forget the name. We'll get to it when we get to it. But I think they have permission. I think the inflation data gives them permission. I think the economy gives them permission. And if we're thinking in terms of interest expense, I think the Fed really has to start thinking about that, because if you don't, that's going to put the debt on, beyond that point of sustainable. It will be unsustainable, because just the interest expense, unless you have radical cuts everywhere else, will continue to produce a deficit. The deficit adds to the debt. The debt increases, which increases the yields, because investors are going to demand more, which increases the interest expense, and so on. So if the Fed can move from being just data dependent and what is sometimes rear view mirror data to forecasting a little bit. I mean, you're giving us a summary of economic projections. You're forecasting out the cuts that you see. So I know you forecast. Look forward 6 months, 9 months, a year at where inflation will be and where the economy will be. At 2.1% on PCE year over year, and a Fed funds rate of 4.33%. If you assume a neutral rate of 50 basis points, 2.5, 2.6% would be neutral nominal, and you're at 4.33. So I agree with Trump on this one. Not cutting would be a mistake, although I agree with him for different reasons. I don't think Trump's desire to see rates go down is data driven. I think it's just desire driven. But I think the data is there. So I don't think they're going to cut, because the cost of a mistake would be low, because, as they pointed out, the job market is resilient and strong. The economy, if you remove the massive run on imports from the first quarter, was still fairly strong, which means the economy can absorb another 6 weeks of higher rates to the next FOMC meeting. The cost would be low, but still I think they should cut. Money market funds, look at that, $7 trillion. You want to get this money to work. You want to get this money out of money market funds and into the capital market to start lowering these rates. Cut rates. At the margin, some of this money will begin to flow out because the market will start to see duration here starting to perform. And if you do cut rates, you handle it in the press conference, right? You get the market on board by handling it in the press conference. I think they can do it. And then you start to get some of this money working for the economy as opposed to just being a draw on government finances, because all this money has to be paid the money market rate. We have some busy economic data this week. Friday is the big day again. We have ISM manufacturing on Monday. That's not really the big one. ISM services on Wednesday. That's the big one to look at here. The prices paid component is what everybody will be looking at, and the employment component of those two. And it is jobs week. You have JOLTS, not that important anymore. ADP, the always wrong ADP, but still market responds to it. And then jobs both in US and Canada we get in 5 days. Some of the data within there is becoming important to look at. I'll show you a little later on. Balance of trade in 4 days, both for US and Canada. This is for the month of April. Also in 4 days, non-farm productivity and unit labor costs from the first quarter. We get that in 4 days. Reverse repo jumped. Well, it's the end of the month. That is normal. Reserves still sitting at a little over 3 trillion. TGA a little over 400 billion. Let's look at Fed funds price term structure. Actually, let's look at the slopes here. We're sitting at 5 basis points on the 3-month to the 10-year. Dropped 10. So if we have another good week on TLT, another good week here, we could reinvert on the money market capital market curve. For Fed funds futures, Q1, call that just positioning and hedging, basically saying 0, 4.32. Let's see if I can write on the screen here, 4.32. The effective federal funds rate is 4.33. If you get no move in June, this should basically end at 4.33. Going out to the next quarter, showing only a little less than 1 cut by the October, end of October funds rate. And you have June, July, and September. You have 3 meetings before then. If you get 1 cut, it'll put this at 95.92, which implies 4.08. There's 4.095 in there, so it could fall another 1.5 basis points. But if you get 2, works out well on a long position. Going out to January, where's our January? 3.775. That's another 32 from Q3. So by the end of the year, basically the market is right where the SEP was last time, a little over 2 cuts. Going out to Q1, which would bring you to April, another 23. So 79, basically 3 cuts in 8 meetings. And here is the May. So what I have in these letters here, by the October, the end of the October contract, you have 3 meetings. By the end of the January contract, you have 2 more meetings, October and December. And then to get to May, you have 3 more meetings in here. So there's 8 meetings altogether. That's where I get the 3 in 8. L means I'm long. I'm long the October 2025 ZQ futures. I'm long the January 2026 ZQ futures. And I'm long the May 2026 ZQ futures. And if you go to October of 2026, I am long that one as well. Total of 28 contracts across those 4 dates, because I think it's just too low. 3 cuts in 8 meetings I think is a little too low. Honestly, I'm not saying they should cut just because I'm long. I'm long because I think they have permission to cut, and I think they will have to cut more aggressively going forward. Last year, I think they made the same mistake. They had permission to cut in the summer. They didn't, so they started with a 50 basis point cut in September. It would have been, I think, better to start with 25 in the summer, but they didn't. I think they have permission now, and if they don't take it now, they're only going to have to do more rapid cuts later on, because we do live in a deflationary world. Unless there is a supply constraint, the pace of technology across all sectors, and I'm not just talking about AI, is deflationary. Real rates all coming down, basically pretty much by the same amount that nominal rates came down, so fully passed through to real rates. So we should expect to see almost no move in the break-even rates, which we pretty much don't see. And OAS continues to contract again. 6.89 on the 30-year. This is as of the 29th, as of the end of Thursday, 6.89%. If, keeping the theme from the first screen, if we can get that another follow-through in the long end of the curve, another 10 to 12 basis points over the next week, that is really supportive for equity prices. The lower you get the longer end of the curve, the better it is for government finances, the better it is for the deficit, the better it is for the debt, and the better it is for equities. And one thing that we have to consider is if you can get an upswing in equities and get an upswing in bonds, you also increase the capital gains income from taxes going into the next year. So it's win all the way around. So I think there's more than ample permission in here. Looking at SPX, TLT, and DXY week over week, up almost 2%, TLT up 2%, DXY only up 0.27%. If we expect continued weakness in DXY, gold and copper, these are clear winners just on the movement in the currency. 1 month, this is spectacular for SPX, 6.28, but let's keep in mind it was really pushed down rapidly by the tariffs, and then of course the Taco presidency pushed it right back up. TLT down 3.57 over that same period of time. If you look at it year to date, fairly even. SPX is up 0.56% just on a price basis. That's just price, up 0.56. If you add the dividend in, it's up 0.87% from the beginning of the year. Even though it was a really good May, the year's not that great, basically flat, 0.87. TLT is down 1.2% on a price basis, but it pays monthly. It has a much higher yield than SPX. So when you consider the total return, you are up 0.19% on a total return basis. This is price plus income. 0.87 year-to-date on SPX, 0.19 year-to-date on TLT. So even though it appears that TLT seems to only go down, it does have a good income component that on a total return basis, you're both under 1%, you're both above 0 and both under 1% for duration and beta. Okay, let's revisit where we are in the continuing saga of tariffs. It's like a soap opera. May 28th, blow to the administration. International Court of Trade. It is a U.S. court, even though it starts with the word international. 10 days to remove all tariffs under IEEPA and Liberation Day. What stays? Anything under Section 232, steel, aluminum, and autos. And anything under Section 301, these are the China tariffs. So these would still stay. May 29th, the very next day, U.S. Court of Appeals for the Federal Circuit issued a stay, a temporary order, while the appeal is reviewed. So this is canceled, and all of them remain in play. And then somebody asked Trump in the Oval Office about the term taco. Are you aware that of this term? Trump always chickens out. So Trump now knows about the term taco. So on Friday morning, we had this truth. 2 weeks ago, China was in grave economic danger. Exclamation mark. the very high tariffs, capital T on those tariffs, made it virtually impossible for China to trade into the United States marketplace, which is by far number one in the world. We went, in effect, cold turkey with China, and it was devastating for them. Many factories closed. That's not true. And there was, to put it mildly, civil unrest. Well, that's not true either. I saw what was happening and didn't like it. For them, not for us. I don't think he was empathetic at all, one bit. I made a fast deal with China in order to save them from what I thought was going to be a very bad situation. Well, I'll agree with that, the word fast deal. Trump makes fast deals, not good deals. And I didn't want to see that happen. Because of this deal, everything quickly stabilized and China got back to business as usual. Everybody was happy. That was the good news! Exclamation mark, exclamation mark, exclamation mark. The bad news is that China, perhaps not surprisingly some, has totally violated its agreement with us. So much for being Mr. Nice Guy. So, that's ramping up. And over the weekend, Pete Hegseth said some derogatory things about China, and China has responded. They're insulted by the whole thing. Then, that evening, the China thing was in the morning, May 30th in the morning. Friday night at 7:16, you had another tweet. It's my great honor to raise the tariffs on steel and aluminum from 25% to 50%, effective Wednesday, June the 4th. Call me a chicken, right? His ego will outweigh policy. If his ego is bruised, and to repair it, he would have to hurt America. He would hurt America. If he had to hurt the world, he would hurt the world. His ego is more important than anything else. He's aware that he's now being called a chicken. He'll show you. Our steel and aluminum industries are coming back like never before. Another big jolt of great news for our wonderful steel and aluminum workers. Make America great again. Followed up with, we don't want America's future to be built with, and I gotta say, it's not bad alliteration. Shoddy steel from Shanghai. That's a new thing now, eh? Shoddy steel from Shanghai. So, 90 deals in 90 days. That never happened. Only the UK, and it's not actually a trade deal. Trade partners, don't believe them. They're just using flattery. Many of them already figured out that if you just say we're going to do some things and you flatter him, you can get pretty much anywhere you want to get with him. They're seeing that the king is not all powerful, but he is angry and his ego matters more than your country. So I don't think these are over, which is why I'm kind of puzzled by the move in equity markets. You have a guy that loves tariffs, and he's going to continue on with the tariffs. You have July, early July coming up, which is the reinstatement of the reciprocal tariffs, and you don't have 90 deals in 90 days. Now you have an angry king who's being called a chicken. Do you really think that these are over? So I would not be chasing price at these levels. Let's look at GDPNow from the Atlanta Fed. The latest estimate, 3.8%. This is on a real basis. That is not nominal. So first quarter, I'll draw out a timeline here. First quarter had a lot of imports, which weighed down GDP. You're going to have fewer imports this time, but you have inventories which will be worked down. That takes off of GDP, but the lack of imports adds to GDP. 3.8 GDP model estimate for real GDP in the second quarter is 3.8 on May 30th, up from 2.2 on May 27th, a jump of 1.6% from May 27th to May 30th. Now, mind you, it is very early in the quarter. The quarter is May, June, and July. We're really just here. And as data comes in, these are all components of GDP. It starts to fill in GDPNow. So if we look at the volatility of the estimate, and this is, let's say, May, June, July, the volatility of the estimate is kind of like this. You know, the volatility, actually, because I did it on this scale, the volatility would be kind of like this. The volatility lowers over time so that you'd have this kind of volatility, and then it tends to, as you get more and more information, it doesn't really move very much, but any report really moves it. So even though it's a move of 1.6. Let's just take it for being early in the process. How did this, let's see what happened here. After recent releases from U.S. Census Bureau and U.S. Bureau of Economic Analysis, the nowcast of the contribution of net exports to the second quarter real GDP increased from negative 0.64 to 1.45. That's an increase of 2.09 because the numbers that we saw for imports, or the trade balance, was cut in half. Only because so much was front run, right? Would now cast a second quarter real personal consumption expenditure growth and second quarter real gross private domestic investment growth, that's where inventories are sitting in behind there, declined. So we have personal consumption expenditure declining from 3.7% down to 3.3%. And for private domestic investment, from negative 0.2 to negative 1.4. Again, as you work off inventories and you sell those inventories, that's not GDP for this quarter. That was not produced in Q2. So if in a quarter the economy really produces a lot of stuff and just builds inventory, that is very strong GDP growth. But then if it just sells all that inventory the next quarter, that is very weak GDP growth. So it is going to work down these inventories. So exports or imports and inventories will offset each other. But still, 3.8%. But again, we are early. So the volatility with each reading, the volatility will change this estimate by quite a bit. We also had NVIDIA's results from this past week. Data center continues to perform, up almost 10% quarter over quarter, 73% year over year. I'm just talking about data center. Gaming really came in nicely as well. That is a big jump and better than it's been for the last 8 quarters. Professional visualization pretty much flat quarter over quarter. Same with auto, pretty much flat, and OEM and other pretty much flat. However, still higher than what it was over the past 8 quarters. So still sitting near the top of its range, but not really growth sectors. Gaming, not bad, but let's face it, this is all about data centers, all about GPUs and AI and training models. This is the story, and the story continues on. I don't know what its growth looks like going forward, but I don't see this as a shrinking company anytime soon. I don't see the data center revenue in any trouble anytime soon. I think it continues to grow going forward, although you can question at what growth rate, right? Looking down for the whole year, quarter over quarter up 12%, 44 billion. The expectation was 43.3 billion. EPS on a GAAP basis, 76 cents. If you annualize that and compare it with its price, that's a 44.5 times PE ratio. Non-GAAP, 81 cents. That's 41.7 on, this is a forward multiple. And this is not growth. This is just annualizing this, your 41 times. If you exclude the charge they had for the new export controls, they would have been at 96 cents a share, which if you just annualize that, again, no growth, puts it at 28.4 times forward earnings. So just some rough estimates here. If our expected EPS for the year is $5, a PE of 30, PE of 40, you got a $150 to $200 range in there. I don't know where the market would put it. On the low end, if we give it an expectation of $4.50 for the year, at that low level of growth, the market would probably go as low as 25 on a multiple. That still gives it a 112.50 price, and this is low end on both. What a nice place for a put strike, right? If you're going to sell puts to generate income on NVIDIA, 112.50 seems like a good place. So 115. See what the 120s pay. That to me seems fairly safe. I don't think NVIDIA's story is over for a while. I'm going to expand on this on another screen. This is chips, this is data center, this is energy. These are the suppliers to the AI AI ecosystem. I think these are the winners. They'll win because they're not dependent on who the AI winner is. They're only dependent on AI as a family being a winner. But within it, I don't know who's going to win. I don't even know if anyone's really going to make any money in model development. And then you have the users, consumers, and businesses, and I think you have winners here and you have winners here with a big question mark in the middle. But for anyone who's thinking that that Nvidia is a short, I don't think so. I don't see it doubling in price over the next year, but I don't see it halving in price either. Again, I think a 112.50 seems like a decent enough strike to sell puts, and I would not be short calls. I would not be short this stock at all. Okay, let's have a look at SPY. Our forward 4-quarter operating earnings, 269.36, down, but not much. Closing SPX 59.11 gives you almost 22 times forward operating earnings. That's not as reported, that's just operating earnings, up from 21.53. In a week where tariffs were out, tariffs are in. Dude, you're a taco. Oh yeah? China's cheating. And how about 50% on steel and aluminum? And keep in mind, you still have July 8th. Reciprocal tariffs. 90 deals in 90 days, you got one. And it's not even a deal. You got one. And this is July 8th. We're June 1st now. So what are we looking at? 37 days? 37 days. All-time high, 612.30, sitting 3.75% below an all-time high. Down here, SPY, anything above 588.69 is bull market territory. Just squeaking above that. NASDAQ firmly there, though. Anything above 492, it's at 519, firmly in bull market territory. IWM and IJR are going to have to wait a while. 206.94, finished at 205.07. You need another $2 up there. And 106.93, we're at 105.37, another $1.60 before you can put those into bull market territory. Both firmly in correction, but not bear market. But the triple Q's down 3.99% from its all-time high. S&P down 3.75%. Large caps still continue to outperform small caps. Been a number of years now, and still doing it. Volatility drops as well from 45th percentile for the last 13 weeks down to the 14th percentile. No fear. Markets pushing up 4% on average below all-time highs, 22 times on the forward multiple. Volatility disappearing. Tariffs off, tariffs on. Dude, you're a chicken. Yeah, hold my beer. I just don't see how the market can stay at 22 with an ego that's very upset. And it is an ego that matters, right? I would be cautious, as I said earlier. I would not be chasing price at this point. I am still short on SPY. I am long on IWM and IJR to the point where I'm almost flat on the beta, and I'm playing the 0-day, 1-day, 2-day to expiration options, doing quite well on those. So I'm going to continue holding that position, but paring it down over time. We have companies reporting this week. LSEG, 8 companies. Or if you prefer Sector Spider, 7 companies. And on the days they report, changes as well, depending on who you're looking at. Monday, Campbell Soup. Tuesday, CrowdStrike. Just on fire with its stock price. All-time highs. Dollar General, and we also have Dollar Tree, Hewlett Packard Enterprises Wednesday or Tuesday, depending on who you listen to. Lululemon and Broadcom Friday or Thursday, depending on who you listen to. So not only can they not agree on the number of companies, they can't even agree on the day they're reporting 1 week out. 1 week out. They can't even agree on that. Now, you can go to their websites and you can fact check all this. You would think that they could write a spider that could get that done. You'd think. But this is just a step too far to be able to figure out, is it 8 companies or is it 7? Is Lululemon reporting Friday or Thursday? Nobody knows. It's a puzzle. Nobody knows. Okay, earlier I said I would expand on this mini ecosystem diagram that I drew. There are chips, data centers, and energy. I think they all continue to win. You have AI development companies in here. I put a question mark. I don't know who the winner is going to be. It's getting to be a very crowded space very fast with the amount of companies that are offering models out there. You can't subscribe to all of them. You're going to have to pick a few. But is this a situation where the model has to be so big that you can almost conceive of this space as being representative of natural monopolies, where 4 companies will never survive, but 1 company will? And this is why utilities have certain regulated areas where no one can compete with them, because if there was competition in a space among utilities, none of them could survive, because the cost to build the utility is so great, you would need almost 100% of the market to justify it. Do we have something like that going on for these big LLMs where you can't have 20 of them? The market, because you need so much size that the market cannot support 20 of them. I don't know. I don't know who's going to win in that space. I know the suppliers to that space look like winners to me, and the users of that space look like winners to me. AI users are consumers and businesses. I can clearly see that consumers can win on this one with just the sheer increase in supply that can happen. I'll talk about what I mean there in a second. Let's go to businesses. There are some negatives and there are some minuses here. Some industries are facing obsolescence. A lot of businesses, the business model cases range from increased productivity if the market can absorb it. That is a big assumption you're making, right? Is you could say, look, we can double our output. Yeah, but so can everybody. So if you can double your output, everyone can double their output. So it's a question of, can the market absorb twice as much output in this particular service or this particular product line? So there's increased productivity, reduced costs. So you may be in an industry where you're saying, look, the market can't absorb more supply, so AI can help reduce our costs and increase our margins. Also, new products or services. I'm sure that the existence of this will open up the possibility to do things that otherwise would have been prohibitively expensive because you would have had to throw too many intelligent humans at it. Some industries that I think are scheduled for obsolescence: test prep. When I say test prep, I specifically mean very standardized test prep. SAT, GMAT, LSAT, MCATs. These where the volatility in the content is fairly low. So from year to year, it's basically the same test with the same body of knowledge. The GMAT doesn't evolve that much. It's fairly stable. These LLMs have shown themselves to be very good at passing these standardized tests, and many of these LLMs are now showing themselves to be very good at teaching and tutoring a standardized body of knowledge. So I see that disappearing. When we go to something like CFA is a little bit more dynamic. On average, about 15% of the content changes each year. And because of that, I think an LLM would have a hard time adapting to that kind of changing environment because it doesn't handle new very well. I'll show you on another screen. When I overlay the LLMs along cognitive domains, and I think that's a better way to think about these things as CDEs. Instead of calling them AI software, I think CDEs is a better name, although we're not going to get rid of AI. This is a cognitive domain emulator. So these large language models are not emulating intelligence. They're emulating cognitive domains. I'll explain that on the next screen. But something like this, I still think that you're going to need an expert in here, constantly in the loop, only because of the dynamic changes. Comma, for now. Anytime you talk about any kind of fast evolving environment, you always have to end with for now. What it's going to look like in the future, I don't know, but it's going to look different than it is today. It's going to be better than it is today. Where does it peak out? I don't know, but that is the trajectory that we're on. One thing that I'm surprised at, really, in our Discord, we have conversations going on about AI, and I'm very surprised at it because I do see a lot of people commenting that have a diamond beside their name. They have a diamond. That means they're a charter holder. When you value a business, you don't say, oh, this business did $20 billion of sales this quarter, so it's worth this much money. You don't say, well, the business did 20 billion of sales this year and it did 18 billion last year, so it's worth this much money. We never do that. It's always forecasting. It's always what will it do? It is worth what it will do. It is not worth what it did or what it has done. No business is worth what it has done. Every business is always worth what it will do. So we buy 100% of the future. We do not buy even 1% of the past. It's 100% of the future that we buy with a business. But when it comes to evaluating AI, I see a lot of comments of it doesn't do this, it doesn't do that. It has these mistakes, it does this, it does that. It's not, it can't replace this, it can't replace that. And we're looking at it as of today. That would be the same thing as saying a business did 20 billion this year, it's worth this much, without ever thinking about the future. If you're going to assess the benefits or the threats of AI, you must forecast out and then discount those opportunities or those threats to today and say, here is the state of affairs based on where we're going, not where we are or where we've been. But I don't see a lot of that going on. Anyways, let's get back to this here. So test prep, coding and app development, I think will obsolete over time. These things have become very good already. And now you may say, but you can't get rid of all of these today. No, I'm projecting out coding and development. Search, the typical URL searching, like Google search. I think that is just, I give that a year before it's a shadow of itself. If you have perplexity, or any of the LLMs, Gemini, Claude, OpenAI, they all have access to the internet. Do a search. Search for what you want using those tools. I would strongly suggest trying Perplexity as a search tool. Once you start using that, and then go back to Google and you'll think, what am I doing here? Like, I got to click on every one of these links. Why would I do that? Try it. You'll be amazed. I think that disappears. Graphic design, I think, disappears as well. You can get a lot done by just prompting, by just giving a very good prompt. It will give you some really great output. And if you haven't done a tour of YouTube yet for VO3 and what can be created in video with just prompts, for some of these, you wouldn't even know they're not real people. It's absolutely incredible. With autonomy, drivers, especially in Class 8 vehicles, I think over time will disappear. Tutoring, K through 12, and maybe even at some university levels, I think that will disappear as well. New product services, well, that's always a question mark, but I'm pretty sure it's going to open up new products or services. And increase productivity for some firms if the market can absorb it. That's a very tough premise, right? I was listening to All In podcast, and one of the arguments made was that it's going to help really increase sales per employee. So instead of having 250,000 in sales per employee, you'll have 500,000, a million, 2 million in sales per employee, which means your ROI per employee is really going to increase. You wouldn't cut back, you would increase, right? Well, that is making an assumption that the market can absorb all of that. And if one company does it, all the companies will do it, all your competitors will do it, and you'll be massively increasing supply. So the conclusion is logical, is companies would invest more in something that has increasing ROIC. However, the premises are false. The premise being that you continue to sell your product at the same price in the face of massively increasing supply. So we'll talk about that in a couple of screens coming up, the idea of premises versus conclusions. What I've done here is I've given a very conservative estimate of what jobs could be eliminated. I'm not thinking about what jobs would be created. Let's just think about what jobs would be eliminated from a very conservative perspective. In the US right now, services producing sector and goods producing sector. Goods producing sector employs about 22 million people, 14% of the working force. Services, 113 million, 71%, and government at all levels have 24 million. Isn't this amazing? Government in the US employs more people than all the goods being produced in the US. Government is bigger than the goods producing sector in terms of employment in the US. 15% of all jobs. Something's wrong there, right? And then it's broken down in different categories: private education, health, professional businesses, services, etc. For goods producing sector, I said let's just assume that robots aren't really going to be a thing in the next 12 to 24 months. Let's say no jobs are lost here. Now, I'm not counting any management jobs in here at all. I'm just saying nothing's going to be lost. In services, you can see how many jobs are in each: private education, health services, 27.2 million. I think AI increases productivity here, such that you don't really have a healthcare worker shortage or a teacher shortage, because these things will help increase the productivity. So you can actually get the work done without having to find employees that probably don't exist. Professional and businesses services, I think maybe conservatively 5% of those jobs could disappear. I put 0 for leisure and hospitality and retail trade. Financial activities, 9.3 million. You'll get both cost reductions here, and I think you could probably reduce headcount by about 10%. I think most financial services firms, if they look at what AI can do and they look at their workforce, they could probably reduce headcount 10% over the next 12 to 24 months. Transportation, autonomy, I think is 2 to 5 years out, so I didn't do anything here. Let's leave it at 6.8 million. Wholesale trade, I didn't do anything. Information, 2.9, I'm dropping that by 40%, because if there is one sector of the economy where AI is really going after, it is coding quite significantly. So I think you can have a headcount reduction here of about 40%. So what I've done is I've just estimated out the jobs: 22.6 times 5%, 9.3 times 10%, 2.9, it's only 2.9 million in there, right? Times 0.4, 3.22 million jobs. That's about a 2% increase in unemployment. So we're sitting up, what, 4.3%? 6.3% is where we may consider it to be normal unemployment next 12 to 24 months. And that's with ACDCs as they are today. I'm not calling them AI companies. These are artificial cognitive domain companies, and what they're producing are cognitive domain emulators. I think what is troubling is the I. Because some critics of AI argue that it is not intelligence. I don't think that there is an LLM out there that would claim that we are intelligence. They are emulating cognitive domains. It is really just code. So It's never going to feel. It's never going to have intuition. It's never going to have any of these things. It really is just a big emulator of different cognitive domains. And I'll describe that on the next screen. When we start thinking about it in terms of cognitive domains, we clearly see its limitations. We see where it's going to win and win big, and we see where it has limitations. Where it will be an augmentation for human skills, and where it will replace human skills. So I've been very conservative here. 2% unemployment. We'll also look at some output from two reports that sort of suggest in around the same number. Okay, so the two reports that I looked at, I used Notebook LM, and I gave it World Economic Forum's Future of Jobs Report 2025. This is a 290-page report, so I wanted a high-level summary first. And SignalFire, State of Tech Talent Report. This is for 2025 as well. And it gave me some output. This is U.S. grad unemployment, U.S. underemployment, and Canada youth employment, because it doesn't break it down per graduate. 2024, 4.6. 2025, 5.8. That is a big jump in U.S. graduate unemployment. In 2021, it was sitting around 6%. We're sitting around that 6% now. 2013, sitting around 6%. After the pandemic, it was basically flat for a while. 7 to 9%, 2008, 2010. So there we are. This is really incredible. The underemployment. How this is measured is people with a degree holding a job that does not require a degree. So you can think of all your poli-sci majors that work at Starbucks. This is absolutely stunning. 41.2% of people with degrees, sorry, I shouldn't say people with degrees. In this category, 41.2% are people with degrees for jobs that don't require degrees. So has university and the push to put people in university gone too far? Yeah, I've been saying that for a long time. 45% of the high school population going to university, that is way too many. All you're going to get are watered down degrees that aren't worth anything. When I saw this number, I was like, this can't be right. So I went and fact checked it. Yeah, that's right. 2024 was 40.6. 2013 was 44%. 44. Like, when you get to the 40%, you kind of have to look at that and say, I think we're doing something wrong. These degrees aren't really worth anything, are they? So I think the university population is due for a dramatic shrinking. A lot of universities and colleges, I think, are going to disappear. A lot of programs are going to disappear. The size of the academic workforce, I think, is going to shrink significantly. In Canada, we only have youth unemployment to compare it to. 11.2%. In 2024, it was 8 to 9%. During the pandemic, greater than 12%. 2008, 2010, 10 to 12%. You're already in that range. I went to the jobs report and I looked at the 20 to 24 cohort, because that is more than likely where graduates are going to be, is in that cohort. Year over year, April 24 to April 25, up 203,000. However, January had an adjustment. So if you're looking at last year, it's kind of flat, and then January just jumps up because it had an adjustment. So not really a fair comparison. So if we just look at January to April, down 108,000. March to April alone, month over month, down 111,000. That is the 20 to 24 cohort. BA Plus, down 11,000. Month over month, down 11,000. So these numbers sort of support what we're seeing over here. Out of these reports over here, let's see what we have from Notebook LM. New grad hiring collapse. The tech industry's hiring, and this is just focusing on tech industry because it's probably picking up on SignalFire. I think this was May or April. This is more recent than WEF's. The tech industry's hiring of new graduates has significantly dropped. Some of these numbers are amazing here. For big tech in the US, Google, Meta, Microsoft, Amazon, Stripe, new grads account for only 7% of hires, down from 25% from 2023. This is the tech industry. 7% down from 25%, and over 50% from pre-pandemic levels. For startups, new grads are under 6% of hires, down 11% from 2023 and over 30% from 2019. Bunch of attributions here: smaller funding rounds, shrinking teams, fewer new grad programs, and the rise of AI capabilities. Unemployment rate for new college grads in the U.S. had risen 30% since September of 2022. We can see that up here, 5.8 from 4.6. Rise of AI and technology. AI and information processing technologies are expected to transform 94% of firms' operations. I believe that. That's just operations. That's just saying the way we do things. I mean, the internet transformed what? 100% of the way companies do things? Right? Electricity transformed how much? All these technologies, general purpose technologies, have these wide implications, so I don't think that's unrealistic. 94% of firms' operations in the US within the next 5 years, higher than the global average of 86%. Robots and autonomous systems are also expected to be transformative for 58% of US employers. US employers are notably more likely to adopt various AI-related workforce strategies compared to the global average, including reskilling existing workers, 87 versus 77, hiring AI for AI design skills, 73 versus 69, hiring for AI collaboration skills, 68 versus 62. This is what, if you have no technical background, AI collaboration skills. This is working with AI, making AI productive, learning how to use it. Reorienting business for AI opportunities, 58 versus 49, and downsizing, where AI replicates work, 58 versus 41, 58 in the US. The report, the WF report, suggests that more jobs globally will be created than lost. Globally, however, when you look at what it suggests is going to be created, it is a lot of it is bringing education to where education doesn't really exist right now. So that the wave of AI is going to be really great for poorer countries, more so than for richer countries. That richer countries will take the opportunity to rationalize their workforce and, of course, take advantage of emerging industries. But this is really going to help poorer countries. So I wanted to separate the WF report, which is global, from Signal Fire, which is just local to the US, and I tried to extract as much of just the US specific numbers as possible. And it doesn't really do it. The reports don't have the information to get it done, and I haven't put anything more into Notebook LM or did a deep research. But anybody can do that now. You don't need me. So we have a research question: is what is going to be the impact on the U.S. of AI over the next 3 to 5 years? It's a forecast, but we ask experts forecasts. We can Google search all that, but it takes time. Or we can use Perplexity Deep Research, Manus Deep Research, OpenAI Deep Research, Gemini Deep Research. Use 4 of them and see what you get. And where they all start to agree, you can pretty much be assured that that's as fact-checked as you're going to get. You don't need me to get that done. There used to be a time where to get that kind of information, you didn't want to spend 6 hours doing all the groundwork. You wanted somebody else to do it and report it to you. Now the AI can do the 6 hours of groundwork for you. My world is shrinking. But I think this is important over here is we're seeing that the U.S. has much more volatility in what it does than the rest of the world. So I think there'll be much more volatility in the U.S. job market. My projection over the next 2 years is an increase in the unemployment rate because of the loss of jobs of about 2%. But there'll be job gains. I just don't know where and I don't know how many. We'll look at that shortly. Task automation versus augmentation. This is eliminate versus help. In the US, the proportion of work tasks performed predominantly by humans is expected to decrease from 43% today to 29% by 2030. That's a 14% reduction over the next 5 years. So that's about 2.8% per year from now to 2030. Let's read that again. Let that sink in. The proportion of work tasks performed predominantly by humans expected to decrease 43% to 29%, while tasks performed predominantly by technology are expected to increase from 26% to 38%. There is no denying that this will displace some work done by some humans. It may not displace 100% of what I do, but it may displace 50% of what I do. So there's two of me, we only need one. Or we can double our firm's output if the market can absorb it. But if we can double it, everyone I compete with can double it, which means for the market to absorb it, with the existing level of employment we have, if we increase productivity, prices are going to have to get cut in half in a situation like that. Unless you can increase employment, if you're going to massively increase productivity, your unit labor costs are going to go way down, prices are going to go down. That's why I believe that this is going to be massively deflationary, is because even though you can massively increase productivity, unless you massively increase pay that goes to consumers so that they can spend it, you're going to have to cut those prices down. They're going to have to come down. Tasks performed predominantly by technology, increasing to 38%. Tasks performed by a combination of humans and technology, projected to increase from 30 to 33%. Not that much. 30 to 33%. Humans, 43% down to 29. Technology, 26 up to 38, with the difference being picked up by augmentation and not automation. Let's take these LLMs, these cognitive domain emulators. You're going to see why I call them a cognitive domain emulator. And let's overlay them across the cognitive domains. We will get a better picture of where jobs will be eliminated versus augmented. Okay, this is a screen from the video going up in the applied level on Monday. I'll explain it on the next screen. This is Bloom's taxonomy of learning. And these are all called cognitive domains. Remember, understand, apply, analyze, evaluate, create. These are all different cognitive domains. So let me walk you through this first before we look at the LLM role and the human role. Remember and recall. Remembering and recall is the lowest cognitive domain. It's a brute force domain. You just have to remember stuff. There's lots of people who can do this. I'm sure you've met many of these people before. When they start talking, they simply repeat stuff they heard somewhere else. Well, you know what so-and-so says about that, don't you? Well, I do. I know what so-and-so says. I even understand what so-and-so says. Do you? Because this is the wrong place to bring it up. We've all met people like that that simply just repeat stuff they heard somewhere else, but they don't understand what they're saying, but they just recall. Above that is understanding, is that you actually understand what you can repeat, so that it means you can teach me what you just said. You can teach me the meaning of what you said. Now, you've heard the expression, those who cannot do, teach. That's where we get application. You may know something and you can teach me something, but can you apply it in the real world? Some people don't have the skill to apply what they understand. And then we move up to analyze. Perhaps the context has to be analyzed first before you choose an application method, so that you know something, you understand something, you can apply it, but it depends on the context. And the context may change, that you would say, this is not the context in which to apply this. This is the context in which to apply it. And I'm going to apply it this way instead of that way. That's analyze. Evaluate is saying, well, sure, you can apply what you know, but there is something else that you can know and understand and apply in the same situation, which will have different outcomes. In fact, there's not one way to do this. There might be four competing ideologies on how to do something. You must evaluate across all of those. So it means understanding several different things, being able to apply those several different things, analyzing the context for those, and then evaluating which one of those you would do. And then there is creation, which is creating something that never existed before, something new, something novel. Now, you cannot understand unless you know something. You cannot apply unless you understand. You can't analyze unless you can apply. So these are all cognitive domains, and these are higher level cognitive domains. Some people can get to the level of understanding but lack the ability to apply. Some people get to understanding, they can apply, but they just can't seem to analyze very well, etc. So in their minds will expand to the level of the cognitive domain that is their limitation. So let's see where LLMs and humans fit in this. And we'll draw a line right here at the bottom two cognitive domains. They excel at remembering and they excel at understanding. If you ask them just for some general knowledge, they're very good at this. They can say, well, Abraham Lincoln said this, and Freud said this. They know all that. They can do all of that. And they can teach you at the same time. They really do well at that. What's the human's role over here? Well, you got to fact check it. Contextual interpretation, understanding novel or ambiguous information. This is where the LLM kind of breaks down. Let's go up to application and look at the role for the LLM versus the human. Demonstrate a strong capacity for application. LLMs will become powerful tools for applying knowledge in structured environments. Pay attention to this, in structured environments. Human problem solving in novel or ill-defined situations. Adapting procedures, overseeing LLM application in critical systems. So yes, they can apply, but you're still going to need a human, especially if it's a critical system, until these things start to demonstrate fault tolerances that are extremely low. Now, this is the state of affairs as of today. This is where these things are as of today. I'm not projecting out 2 years. What has happened over time is that each iteration of the LLM moves higher up in the cognitive domains. It is moving up. Let's go to analyze and evaluate. Look at the words here. Can assist, can assist. Strong capacity, they excel at. Can assist, can assist. What are humans going to do? Critical thinking, bias detection, strategic interpretation, complex causal reasoning, interrogating assumptions. Here we're looking for the soundness of those assumptions. For evaluation, ethical judgment, value-based decision making. Now, when we say ethical judgment, that's not just being woke in this sense. Keep in mind, an LLM digests everything that it can get its hands on. All of these novels with all of these villains. But it has no value judgment to make whatsoever. For the LLM, it's just a language model. Evil, which is embedded within stories with villains, is the same parameterization as good people and heroes. So when it is looking to apply its knowledge, it has no value judgment between how a villain did something and how a hero did something. So there's going to have to be something in the system somewhere where there is some kind of ethical, oh, we can't do it that way. Come on now. That's clearly, we can't do it. So you need some kind of ethical judgment in there, value-based decision-making, strategic assessments, quality control, oversight of automated evaluations. There's that word, right? Then when you get up to create, LLMs will serve as powerful co-creation tools, but true innovation and the development of new paradigms will likely still require human ingenuity, intuition, and emotional depth, something the LLM probably will not get because they are not intelligent or intelligence. They are cognitive domain emulators. They can emulate a cognitive domain. Some cognitive domains they can emulate really well, some not so much. Human role, original ideation, strategic innovation, ethical and impactful design, setting creative vision, leading groundbreaking research and artistic endeavors. So the human still has a role from about here on up, right? The higher cognitive domains, analysis, evaluation, creation. And this is why I think for something like the CFA, level 1, I think an LLM would pass level 1 without much issue. Because level 1 really works at these cognitive domains: remembering, understanding, applying. Level 2 moves up to here. So I think an LLM could probably pass level 2, depending on how much weight is given to analyze questions. Level 3, on the other hand, moves up here. I don't think an LLM could pass a level 3 exam. I think it would have a hard time passing a level 3 exam because it does require higher cognitive domains. When I said that your job is to get into the right tail of the distribution as quickly as possible, that is not the right side of the distribution in any one cognitive domain. That is the right side of the distribution across the cognitive domain. So if we think, and I'm just going to borrow some space from the screen here. Oh, why did that not work? Let's try that again. Let's just erase that. There we go. And if we think about the normal distribution here in terms of cognitive domain as opposed to domain knowledge, I suppose I know a little versus I know a lot. Well, if all you're doing is measuring one cognitive domain, it doesn't matter if you're in the right tail of remembering, an LLM will obsolete you. It doesn't matter if you're in the right tail of understanding, an LLM will obsolete you. So if your cognitive domains are from application on down, that is where you're going to get automation of a human task. If the human is doing nothing, than that. So this is why I think tutors will disappear, because tutors work at the level of understanding of the knowledge they remember. LLMs can do that. I think that will be completely automated. Even at the level of application on down in many domains, application in coding, for example, LLMs will replace humans, not unless you get to the higher cognitive domains. So if we think of the normal distribution in terms of the cognitive domains, understanding, application, analyzing, evaluating, creating, your job is to get into the right end of that distribution in whatever job you have as quickly as possible, because while the LLM can eliminate these functions from you, it cannot eliminate these. These would be augmentation, augmenting your analysis and evaluation skills, and you get it to do all of the application and remembering for you. But again, if your job mostly lives in the lower cognitive domains, you will be replaced, because that's where the LLM is really good at. If we accept that this is a cognitive domain emulator and not an intelligent system, it is doubtful to see how it can get to this level to have intuition, emotional depth, ingenuity. I don't see that out of code. I see it emulating a cognitive domain, but some cognitive domains require a lot more than just simply, I know this stuff. Let's go to the next screen. Okay, so here is the thought that I had. So I developed a plan, is that I'm going through this development of this module, AI in finance, and I'm showing you how to use different AI tools in finance. But if you're living at these lower cognitive domains, I can show you these all day long. It's not going to save your job. What it will do is make it obvious to you that AI can replace everything you do. So how do you get into the right tail of that distribution? You would think, well, I need to know more about how to use AI, or I need to know more stuff about my domain. And it's not the answer. You need to move higher in the cognitive domain. Think about it like you're on an island and the water level is rising. You got to move to higher ground. And that's what we're doing, moving to higher ground. So I thought, while I'm doing the AI in finance, why don't we do something for critical thinking and critical reasoning, specifically for the domain of finance? Not just some general critical thinking and reasoning, but let's use it in the domain of finance, so that we'll use finance targets to do a lot of these exercises. So we'll do, AI tools followed by critical thinking, and critical reasoning followed by AI tools, so that it gets you digitally literate in AI tools, so that it can augment you and increasing your cognitive domain. This is not about knowing more stuff. It's about how you know that stuff. So let's go through what the plan here is. Identify and evaluate arguments. Recognize premises. Whenever anybody says anything, blah, 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 therefore, we tend to always focus on the therefore and forget about this. Once you learn this stuff, the critical thinking, critical reasoning techniques, you will see things differently, and you can't unsee them after the fact. Sometimes you look at things and you go, I don't know why people are believing this stuff because of this. You can't unsee it. Recognize premises, conclusions, and the structure of arguments in various forms of communication. This is a big one here, is framing. And we'll use some companies' outputs to show how they frame certain things. And based on how they frame, we'll go back and say, well, what are the premises in this conclusion, and are the premises sound? Beyond Meat, BYND, was a great example of a company that would give you a structure of an argument that would frame things. But when you went to the premises, you saw that the premises were not sound, that they were really engaging in just PR at that point. So it is powerful to be able to see the whole argument. There's this word, evaluate. Right? That is one of the higher cognitive domains. Identify and evaluate arguments. Detect common logical fallacies. Identify and explain logical fallacies that undermine sound reasoning. Apply analytical frameworks. Utilize structured analytical techniques to break down complex problems. There, look at that. Evaluate evidence. Inductive reasoning, deductive reasoning, abductive reasoning are just some examples of analytical frameworks. Develop evidence-based reasoning. Distinguish between reliable and unreliable sources of information. In finance, this is absolutely critical because information is everywhere, and some of it, much of it, unreliable. So we need to distinguish between what is reliable and what is unreliable, and sometimes company information can be unreliable. Specifically on this one, MSTR, we'll look at MicroStrategy, and we'll look at some of the information they put out there, and then we will just go to the evidence, and we will find that most of what they put out there is massively misleading, if not false. So while they make logical arguments, they don't make sound arguments because their premises are false. We'll be able to find that. It's a great case study here. Recognize cognitive biases, and we all have that. And AI can really help on this one. So what we can do with AI is we can put in our belief. This is what I think. Prove me wrong. Just ask it. Prove me wrong. And it will counter your confirmation bias quite effectively. Identify personal and common cognitive biases that affect decision making, and develop strategies to mitigate their impact. This is what we're going to focus on. If you've been through the CFA program, you've had your fill of the cognitive biases. Construct sound arguments. That means the premises are sound. If the premises are sound, the conclusion is sound. If the conclusion is logical. However, you can still arrive at logical conclusions from unsound premises, right? So one example was, again, the All In podcast, the suggestion that this can massively increase sales per employee and companies will hire more employees because ROIC on employees will increase. But if AI can do that, it can do that for everyone. That only works if the market can absorb all of that supply at that existing price. Unless you pay people more, unless wages increase at the same rate that productivity increases, the marketplace can't absorb it. The premise is not sound. Even though it's a logical conclusion, the premises are not sound. Once you start seeing the world that way, you cannot unsee it that way. It just stands out. It jumps out at you saying, well, hang on. Yes, your conclusion is logical, but from unsound premises. Formulate well-reasoned arguments with clear premises leading to logical conclusions. Engage in productive dialogue. Apply principles of charitable interpretation. That means you are going to steelman the other person's argument. And you'll be able to identify straw man arguments very quickly and dismiss them very quickly. Apply principles of charitable interpretation and effective questioning to engage in constructive discussions. If you can steelman the other person's argument and still tear it down, there is no argument there. Apply critical reasoning to real-world scenarios. Here we'll use a bunch of real companies and real cases to get this done. Transfer critical thinking skills to practical situations of professional, academic, and personal contexts. So I'm going to put this whole roadmap in with AI. If you've ever sat through or done a PhD program, you have gone through all of this ad nauseum. You have had this drilled. Every paper you read, you go through the same critical reasoning and critical thinking exercises to get through it. What are the assumptions being made? Do you agree with those assumptions? Are they sound? So it's sort of second nature after a while. And again, like I say, once you know this stuff, you see these things just jump out at you. You see the world differently. So that will be interspersed with the AI tools. My thinking is, what is the point of teaching you all of these AI tools if you come to the conclusion that, well, if AI can do this, what the hell am I going to do? And if we, as I said earlier, move away from the word intelligence and start adopting it as cognitive domains, and these are cognitive domain emulators, they will emulate very well the first three levels of Bloom's taxonomy. You need to move to analysis, evaluation, and creation in the domain knowledge that you have. And that's, yeah. The first video is up on the critical thinking stream, will be up on Monday. And that's it for this week.